So, welcome on stage.
Thank you.
Thank you.
After this brief overview of what we're going to talk about, I'm super delighted to have you both talk about this relationship between investors and funders. And let's maybe start with a quick intro as to what is your role in these alternatives to corporate governance and ownership. So, Maike, you are co-lead at the Purpose Foundation. The Purpose Foundation was founded in 2015. Since then, it's worked to build an economy that serves the people, the planet, and the society. You've leveraged, basically, through the Purpose Foundation, these examples of alternative ownership structure. And you first defined, with the Purpose Foundation, and coined the term steward ownership, right? And you have, through the years, then been able to leverage that notion of steward ownership through different activities. The Purpose Foundation is known for consulting works, for non-for-profit activities, and you have two investment vehicles, the venture and more of the private equity arm. So first, maybe for those that are uninitiated with steward ownership, can you give us a little bit more of a concise explanation of what this is and what has been your journey at the Purpose Foundation to promote that concept?
Sure. Thank you very much for having me here. Maybe I can start off with kind of the journey of the Purpose Foundation because it brings us to steward ownership quite nicely. The Purpose Foundation and the whole Purpose Network was founded really with the question of how can we build companies that are contributing to an economy that serves people, planet, and society, that basically contribute to, solving problems for society and for their customers, not to creating problems to make profits. And we very quickly realized that in order to do so, we needed to look at the deep design of companies. We needed to look at the question of, who has power and why, and what is money in the company, what's the role of money in the company. And these questions are kind of on a deep design level on ownership and financing. So we started to look around for examples of ownership structures around the world. And we first found a lot of examples that we didn't find so inspiring, examples where money buys power over companies. So whoever has the most money has the most power over these companies that influence all of our lives. Or examples where companies were really only existing to create wealth for the shareholders and didn't have a bigger purpose than that. But then we also found really cool examples, and some of them you already had on your slides. So examples like Robert Bosch with 400,000 employees in Germany, examples like one of the largest pharmaceutical companies in Denmark, Novo Nordisk, our John Lewis partnership, you also had them on the slide. And all of them really fundamentally rethought ownership, and that is where we come to steward ownership, because we realized when we started to look at what they do differently, we realized that while they all had really different legal structures, they all shared kind of the core understanding of what the company was and what ownership over the company was. And they all shared two principles. And the first principle here is the principle of self-determination. That means that the voting rights over these companies, so the last instance of power over these companies, always remain with people connected to the company and kind of actively taking on responsibility in these companies. So voting rights and power is not speculatively sold, it's not automatically inherited by anyone, but always remains with people close to the company, and the company is kind of self-determined. First principle. And the second principle is the principle of purpose orientation, and that means that the value created in these companies serves the purpose of the company. It's not there for the shareholders of the company. It's not kind of a goal in itself to make profits and to create shareholder value, but actually profits are a means to an end in these companies. They are reinvested, they're used to cover capital costs, they can be donated, etc. They can be used entrepreneurially, but serve the purpose of the company. And now all these companies, what we found really impressive is that they don't just write these principles on the wall and kind of follow them, but actually legally enshrine them in the long run over generations of entrepreneurs. So we realized, well, okay, they all share the same thing, but they don't have a name for it, they don't talk to each other, they don't know about each other. So we thought, well, let's give them a name, let's give this concept a name and define it and start talking about it. So we came up with the term of steward ownership, and we started to talk about it. And write a book about it, and then kind of developed a whole nonprofit around it. And then sooner or later, entrepreneurs started coming up to us and say, we want to do this. Like, how can we do that? Help us. So we helped to design kind of legal structures for implementing steward ownership. We started to consult companies on their path to steward ownership. And then at some point, entrepreneurs came up and said, well, we really want to do this. We know how to do it. But how can I get investments in this structure? And for a while, we always said, that works. Like, we know there are solutions for that. And at some point, we realized, well, there are solutions for that, but really we have to create more examples. So we started to invest exclusively in steward-owned startups with one fund and exclusively in steward-owned small and medium-sized businesses with the other.
And we have a living example here with Christian. Thanks a lot for joining the panel. So you're a co-founder and CEO of WILDPLASTIC, a steward-owned company, which is also kind of invested by Purpose Venture. Can you tell us a little bit, like, how did you come up with this idea? Because at the end of the day, you essentially gave away the right to exit. What was the thought process on this journey to become steward-owned?
Yeah, so first of all, good morning, everyone. I am Chris, the co-founder of WILDPLASTIC. And first of all, what do we do? WILDPLASTIC, the name kind of gives it away. We recover plastic from the wild. 80% of the world's plastic is out there in the environment. We try to get it back and recycle as much as possible from it. But this is not what I'm going to talk to you about today. It is much more about the deeper layer of what else we did differently. And we started the company in 2019, and our ambition was not to just create a plastic recovery company, but to deeply also think about, well, the system that is here, that is deeply flawed, how do we fix it in the future? And obviously, we won't do it with the tools of the past. And if companies contributed to the problem, how do they deeply contribute to a solution in the future? And that is a systemic question. And so we all asked ourselves, well, what do we do differently when we start this company now? And I think that thought process brought us to the question of, well, how do we make sure that WILDPLASTIC recovers plastic until the job is done?
Like a long-term orientation?
In the long term, this might take 100 years or less or more. I don't know.
So you want the company to actually exist beyond your even lifespan, hopefully.
Yeah, well, it would be cool if we fixed the problem earlier, but let's say this will take 100 years. How do we make sure that purpose is being the main focus until the very end? Embedded
maybe also in the bylaws? Is that part of the Articles of Association?
Exactly. And now, the problem is this was not available even as a model to choose from at the very start. What you see is you start a company and you VC fund it. That is one way, or you bootstrap it, or you are a non-for-profit. And those were kind of the three options I saw.
Or you're already profitable and you can get some bank debt.
Well, but when you start the company, you're usually not you're looking for the first customer.
Unit economics.
But so this is actually where we were lucky enough to get to know the Purpose Foundation, who kind of explained to us that ownership is that key question that we were actually looking for the answer for systemic change in what we do in the long term. Because this deeply drives of how WILDPLASTIC is going to function in the future, even beyond me and beyond everyone else that's working there.
So not only you're working on the what, I mean, providing some sustainable materials for changing the way we live, we consume, we produce, but you also look at the how and how this sustainable mission can be kind of long-term oriented and fulfill that mission for the long years to come.
I mean, Sabine, the point is we started this journey because I believe in the notion of regeneration instead of further extraction. It's kind of, hey, let's regenerate the world's wild plastic instead of extracting more oil to produce more virgin plastic. That is the simple belief that this is the right thing to do. If that is our belief, what is the adequate or corporate model to follow suit? I think this is, that was kind of our thought process.
And I'm guessing this journey has not been so easy to implement. Otherwise, maybe some of the entrepreneurs around here would have also chosen that path. What are the can you kind of deep dive into the specific challenges you faced? being, you know, on finding out that Purpose Foundation was existing.
Yeah.
I mean, we were talking a little bit earlier about the lack of information, and I'm pretty sure that a lot of people never knew you existed, but also kind of the legal framework, like finding additional capital, etc. And maybe also, Maike, just with the examples from all the companies you invested in, like what have been the challenges so far?
4 challenges. Number 1, we had to be lucky to run into the Purpose Foundation. It was pure luck. It might have as well not happened, and then we would have chosen from the conventional options. Number 1. Number 2, what we did is technically not an available option. It is a hack that we did with the Purpose Foundation with the golden share model. Golden share meaning we give away 1% of our shares, and with this 1% to the foundation, and with this 1%, with that veto share, the foundation guards the 2 principles of self-ownership and reinvesting profits into the purpose.
So it has a veto right?
Yeah, they have a veto right, but this is a hack. It's not a public corporate model that you can choose from the list. So that's a problem.
And why is that? So there is no legal framework, maybe, Maike, in terms of like having different options to choose from a startup perspective? Like the legal framework, the regulatory framework doesn't help.
I mean, there is not, but there might be in the future, Maike.
Yeah, exactly. So, I mean, next to the information lag, definitely the legal infrastructure for steward ownership is currently all over the world, to be honest, not very good. So we do have some countries where it's a bit easier, where we can use kind of enterprise foundations, so foundations that are targeting, or that exist to hold ownership over companies.
Like Fondation Actionnaire in France, probably?
No, the French one are a bit different. That's getting too technical, but in Denmark we see those, for example. Or I'm sure a lot of you guys have heard about the example of Patagonia, and they use the trust structure in the US, so they use the perpetual purpose trust. You can also use employee ownership trusts, or the golden share model. And in Germany we're currently in the government has actually decided to implement a legal form for steward ownership separately from other legal forms. But we're not there yet, and so it's still a path to go. But we definitely need to improve the legal structures, yeah.
And that's part of your work at Purpose
Yes.
Foundation to kind of promote this new legal form.
If I can interrupt you, I think Maike is playing this down a lot. It is a gigantic, massive achievement to not only get the political buy-in, but to get it actually on the roadmap to create a new corporate model. I think the hopes are this happens within the next
2 years,
1.5 to 2 years. But what this changes is that the Chris of the future who sits in front of the list of corporate models to choose from, it is a list.
It has the option.
Yeah. Has the option.
Yeah, it's a state-based kind of model. It's not something that private organizations are trying to kind of bring into the world, but it's actually something that's a valid kind of state-based option.
And also maybe to make that clear, what Patagonia did is amazing, but they also did it, I don't know, 40 years after incorporating, being highly profitable, and then having the luxury of making that decision. What about someone who starts a company and who has essentially, I don't know, €0 in the bank? How do you do that? This is the big change that is coming.
Because you wouldn't have to non-experienced lawyers that will charge you a lot of
the
euros
monetary
or
funds
dollars
to start a foundation, and so I think it is a game changer, especially for startups and entrepreneurs and small and medium companies.
So they need to move to Germany, because I don't think it exists in any of the
Yeah, but we're getting more initiatives around Europe, to be honest. There's also an initiative for a new legal form in the Netherlands, and I think in some Liechtenstein, I think.
Okay, so it's moving, it's going in the right direction. What did change in the relationship to your investors when you became steward? I guess during this journey, when you decided to become steward, you kind of created a little bit of anger from the VC scene that could not invest anymore into WILDPLASTIC. But I'm sure it had also some benefits. Could you tell us a little bit about this?
Yes. So I think the VCs weren't as angry because they, just like us, they realized it is not a typical VC business case. So what we're doing is we're not creating a new technology that is going to exponentially solve the plastic crisis week by week. but we actually have a profitable long-term model of recovering ton by ton from the environment, which is going to take decades time. It is not a VC model, so they weren't as angry, and it simply wasn't suitable for us as well. And the challenge I wanted to share as well is, well, after incorporating, after getting that done, well, how do we fund the company now? Because if VC money isn't available, rightly so, and we're also a non-for-profit and we don't have the funds to bootstrap, what do we do now? And I think this is, this was the big revelation for me, that actually there is investors out there, there is, well, partners out there who think alike and who kind of have the same vision of...
Who are these type of
one of them is sitting over there. Patrick, he's going to talk in a second.
Exactly.
But it is business angels. It is some organizations like Purpose Ventures, but it is also how do I say this? It is daredevils like Planet A Ventures who said, "Hey, we're going to dedicate." It is a VC fund, and they dedicated a small percentage of their funds
assets under management,
as a prototype, as a, you know, let's test this out because we believe in the systemic change of this. So it is essentially, it's a big range of investors who think, hey, long-term impact, patient capital, and adequate capped returns is something we believe in too. It is something that changes the game.
Yeah, and maybe also just investors and investment funds that realize that the models we currently have, they are not really suitable for all companies they want to invest in. So kind of investors that are also, as the entrepreneurs, are looking for more coherent structures to their intentions, so more intentional ways of investments as well. So we definitely see connects there as well.
Yeah.
And maybe, Sabine, to your question, what changed? Because I just explained that we did find investors in the first place, which was a huge achievement. But what I did observe is, well, the relationship is quite different because there is no, there is a power shift. Because the voting rights, they stay within the company, they stay with us. So technically, the control over the company is still ours. And what this made for me is that it actually created a level playing field, and we are, the relationship, if I had to describe it, is very collaborative and very, well, just solution driven. We come with the problems and challenges and consultations and questions to spar with our investors and find the best solution for WILDPLASTIC.
Because the relationship is much more balanced, right? So
because we're kind of
still have the control.
We're circling around the problem of how do we drive WILDPLASTIC forward best, and what does this organization need right now, and this is the incentive everyone has. And that is quite different, I believe, because there is no other...
You're aligned, so you have an alignment of
sometimes hidden power dynamics happening.
Yeah. But so just to come back on the type of profiles of investors that are interested into steward-owned companies and are co-investing with you, are they looking for returns or are they looking for doing good, right? I mean, we're not saying it's philanthropic money. They are actually looking for returns. So how do they get their returns if they cannot exit?
Yeah. So maybe that's one of the biggest differences from kind of investments that are aligned to steward ownership, to conventional equity investments, is that the liquidity for the investors stems from the company itself. So at some point in the future, maybe over several financing rounds, the company pays back the investor plus a return for the investor. And what that means is that everyone is aligned to the company having to become profitable at some point, and to the purpose of the company. And so the kind of the liquidity generation is one of the main differences, and then the return is also really different, because in our conventional investment world, we have potentially unlimited kind of skyrocketing returns, right? We bet on the company growing and growing and growing, and then we sell it, and with selling it, the next person bets on the company growing even more so they can sell it again. And there's this unlimitedness in the return, whilst in steward ownership, investors and entrepreneurs together have to talk about what is enough, how much is enough, how much is risk adequate for the investments I do, for the risk I'm taking, and that can be extremely high. Like, I'm not saying that it has to be really low, but at some point there's a limit, there's a cap to the investor's return, and that can be a cap in numbers, that can be a cap in time, that can be a different process of how kind of the relationship is ended, but there's this potential of the relationship between the investor and the company ending at some point.
And this is something you discuss before the exit happens, right? So you actually put the discussions around valuations at the forefront of the relationship between the fund, and I guess this also calls for transparency and managing expectations.
Exactly, and I think naturally, so I mean, you start off and there is nothing, there is an idea and a team, and there the risk is quite high, and then over time you prototype, you find product market fit, you may find first customers, you create revenue, and the risk decreases, and at one point I think the returns are maybe closer to a bank loan than they are to a high-risk early investment. Yeah, well, and I mean, this is our ultimate goal as well, to become bankable, to be able to get a loan from the bank, which is the cheapest money from which we can drive our operations.
Yeah, but just to kind of also include the other side, we also know of more venture-like cases. I mean, WILDPLASTIC, you were a venture-like case in the beginning, but now you're already a bit more stable, maybe. But for example, OpenAI, they are like financed in a steward ownership aligned way, and are structured in a steward ownership aligned way. And in the beginning, the investors were promised 100x return. So you can really have like extremely high potential returns as well, if the company at some point becomes profitable and can actually pay investors back. So there's still this risk of venture capital, obviously.
I have a last question, which is a bit like playing devil advocate, because we see a lot of this recycling of capital. So I'm accumulating wealth because I'm an entrepreneur, I've been successful, I've been serial entrepreneurs, and I decide then to reinvest my wealth into the next startups, right? I mean, this is how Silicon Valley has been built. We've seen examples here in Europe, you know, the BlaBlaCar, the Flixbus, the N26. A lot of these founders or first-time employees have accumulated wealth, and they are able then to start their own startups. So that's kind of invigorating the innovation ecosystem. What happens if, you know, all these companies are steward-owned, which means that most of the value stays in the company, and these people don't get wealthy to reinvest in other startups? How do we do this?
Well, I would say it is down to the company to reinvest those profits, and that is
to spin off then another, like an intrapreneurship.
Right? I mean, it might be closer to their purpose, and it might be closer to their area of interest, but I think what we're talking about is the profits are there, and the question is, what are they being used for? Yes, there is amazing examples of spin-offs and recycling of investment, but that can still happen. I think the decision is just made within the company, by the organization, maybe by a board of people rather than one single founder.
Yeah, and we definitely see examples like that, like Ecosia, the search engine that plants trees, that's kind of diversifying in kind of what they are doing, or also the bigger examples like Patagonia or Bosch, and how they diversify their approaches. And I also, a different answer to that as well, that's leveling the playing field, isn't it? Like, then we don't have some, like, very few entrepreneurs that because they have the funds can build the next company, but we actually have a level playing field where the people with entrepreneurial energy and kind of vision and really entrepreneurial spirit can build the next company. And that can be people that have built companies before, but it can also be others. And I think that kind of level playing field is something that's really beautiful around steward ownership.
And I think it's also like the concept of this stakeholders versus shareholders, that it's not concentrated, the wealth is not concentrated in one individual. So, for example, in our fund at Masawa, we give 10% of our GP carry to founders, which means that we believe in solidarity capital. And then we have also a cap, actually, on our returns. So our returns are capped. Anything above a certain multiple on invested capital goes to a foundation, which has the same mission, but through different projects, because with Masawa, we cannot invest in every single project. So they would be able, for example, to invest in non-for-profit. So these are the type of structures where, like, the concentration of wealth is not uniquely singled out by one individual, but actually spread across the different stakeholders.
Yeah, and focused on the purpose of the company, focused on what problems the company wants to solve for its customers, for society, for the planet. So it's basically not focusing wealth for private individuals, but focusing wealth for a purpose, for something that's done with it. I think that's the main difference.
So for the entrepreneurs around in the audience, what type of business model, what type of companies are more applicable to these new alternatives, corporate ownership and governance models? Do you have a specific, do you need to be a specific company to be actually steward on?
I think before I saw the case of OpenAI, I would have said, well, you know, there is maybe a smaller range of business models.
A profile?
The type of profile is maybe a bit more narrow. I think that's not true anymore. Technically, you need to be convinced that it's the right model for you, for your business.
So it's not going to replace venture capital.
Not in every place.
It's a new asset class between different
absolutely
others.
about diversity of models and choose the right for you. Much less so than saying, hey, one size fits it all. That never worked.
The nail and the hammer.
The nail and the hammer.
Yeah, absolutely agree. And putting other words to that, I mean, we've built up a monoculture of companies and of ownership and financing for companies with one very specific model and a specific narrative around ownership and financing. And steward ownership basically opens up the options you have, creates a permaculture of companies. So I agree to that. And I would also, I mean, we see so many different companies like startups, medium-sized businesses. We see a lot of companies using the model for succession as well. So we've talked a lot about startups here, but really Patagonia, for example, that was a succession case, obviously. And in really all different fields, but I think particularly fields where you have users or customers where that you want to make a promise to. You want to promise that the company is there for a purpose and that it's not like you don't use them as a means to create shareholder value. And also, I mean, we talked about OpenAI, so I think the whole artificial intelligence sector, digital platforms, etc., where there's just so much uncertainty of where that will go in the future, where it's really beneficial to have a structure that gives you a bit more security as to what is done with it.
Yeah, also like decentralized model, which would be also kind of enabled by blockchain. A few last words for our audience. What would you wish for, or how can you basically promote this to other entrepreneurs, other co-investors?
I would love to have more conversations around, and honest conversations around the question of, hey, where do you want to go with your business? What is actually your plan? And, you know, what is kind of, like, what is the model you dream of, if you could wish for it? Because I think right now there is just boxes to choose from, and there is much more in between. And I just want to encourage all entrepreneurs
to be creative, to think outside of the box.
To be creative, to think outside the box, and also to be brave and believe that there's more people out there with the same vision. Because I think ChangeNOW shows it. There is a lot of people moving into the right direction, and that goes also for corporate models.
Yeah, I can also only second that also for investors. I mean, we see this huge movement currently starting to roll around alternative ownership and financing structures. We see more and more business angels, funds approaching us saying, hey, we want to invest in steward ownership. Can you tell us how to build up the investment fund and the financing structures for that? And I think it's just something where everyone should at least take a look at the different models that are out there, and this really realize that whatever ownership and financing structure you decide on, it's a choice. There's not just one path that you have to go because everyone is doing that, but you have a choice who has power and why, and who has money and why, both as entrepreneurs and as investors. And also, just last message is that we are still also finding new solutions, and it's kind of an emerging field, even though it's backed by historic kind of examples, but it's still quite innovative and new, and we are finding new financing solutions, we're finding new fund structures, we are finding new legal structures, obviously, as well. So just an invitation to everyone who wants to join this, wants to learn, wants to think about it, to do so.
Yeah. And you're going to be a little bit here after the talk, so that you can talk about a little bit the way forward with all these entrepreneurs around that want to maybe envisage steward ownership. So thanks a lot, Christian. Thanks a lot, Maike. That was a wonderful panel. And I will welcome our next panel to kind of travel a bit higher in the value chain, talking about VCs and their clients. So thanks again.
Thank you very much.